All right. Hello, Mr. Smith. So, how are you doing today?
I'm good, thanks.
All right. So, what brings you here to my office today?
I'm looking for a house for $500,000, but I don't know anything about mortgage. I would really appreciate if you can help me.
Okay. So, I can definitely help you in terms of everything you need to know for a mortgage. So, a mortgage is a type of personal loan, and personal loans are primarily used for when you're trying to make a big purchase. In your specific case, you're trying to buy a home. So, a personal loan is obviously paid over time with interest back to the bank. So, what range are you looking for this home?
I'm looking for $500,000.
So, if you're looking for a home in the $500,000 range, so there are two types of mortgages that you can use. The first one is called a conventional mortgage. A conventional mortgage allows you to have 80% of the value of the home as a loan and the remaining 20% as a down payment. Now, if you don't have the 20% down payment, you do have another option. And your next option will be a high ratio mortgage. And with a high ratio mortgage, you can have up to 95% of the value of the home as a loan and the remaining 5% as a down payment. However, with that, you're going to have to pay premiums and mortgage insurance and premiums. Any questions so far?
No, I'm good, thanks.
All right. So further, you're going to have to understand how interest rates work and how there are two types of rates. There's a fixed rate and there's a variable rate. So in a fixed rate, the rate will stay fixed for the particular term, which will, for example, be 5 years, let's say. So for that particular 5 years, your interest rate will stay the same. And when is the best time to utilize a fixed rate? The best time to utilize a fixed rate is when you estimate that the interest rates will increase over time. So then you can keep the same interest rate and pay less interest over the next couple of years. In terms of a variable rate is when the rate of your mortgage changes as the interest rate changes in general. So a variable rate can be utilized or would be the best option to choose if you estimate that the interest rate for the next few years will go down. And if the interest rate in general are going down, that means your mortgage interest rate will go down, which means you will pay less interest on top of your mortgage. And to conclude, there's one more important thing that you must understand when it comes to mortgages. There are two terms. There's something called a term and a amortization. The amortization is the entire time frame in which you have to pay off your home. So let's say you get a loan for a 30-year amortization, which means you have 30 years in total to pay off this home. Within that large scale of 30 years, you're going to have terms. Terms, for example, are going to be every 5 years. So every 5 years, you will have a new term. And what great thing that banks allow you is the flexibility to adjust from a fixed rate to a variable rate and or a variable rate to a fixed rate. Within the term, for example, let's say 5 years, you can make great estimates and allow you to benefit and pay the least interest that you can possibly pay over those next 30 years. And you can also renegotiate and make certain changes within your mortgage, which will allow you to pay off the mortgage as easily as possible and put you in the best position when it comes to purchasing your home. Do you have any further questions?
No, I'm good, totally understand. Thank you so much for your help.
All right. Thank you. Have a great day, sir.